Good afternoon, ladies and gentlemen, and welcome to the K3 Capital Group PLC final results for the year ending 31st of May investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time using the Q&A tab on the right-hand corner of your screen. Just please simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting, but the company will review all questions today and publish responses where it's appropriate to do so. These will be available via your Investor Meet company dashboard, and we'll notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Andy Melbourne, CFO, and John Rigby, CEO. Good afternoon to you.
Thank you for the introduction, and good afternoon, everyone. Those of you that have met us before will understand the format of our presentation, but for those that haven't, firstly, we'll talk at group level, recapping on how K3 has evolved, what's been achieved over the last financial period, which is quite significant. We'll then split off into the three divisions of M&A, restructuring, and tax to give a more detailed insight into the divisional highlights, the financial overview, and the KPI performance of each business area. Before coming back to group level, Andy will then talk through some of the financial statements and highlight some of the key areas of consideration there, before closing with an update on current trading over the first 3-4 months of FY22, and then, as suggested, with a Q&A session at the end, hopefully, for everyone to ask whatever they need to ask. So, Andy, if you can just flick over onto group highlights for me, please. The last 12 to 18 months has clearly seen significant change for K3 Capital. As you know, during the early part of FY21, so last summer, we identified, transacted, and subsequently integrated two quite transformational acquisitions, highly accretive acquisitions in both Quantuma and Rand. Those acquisitions have then been complemented by 3 smaller bolt-on acquisitions during the period. We've launched 2 new service lines, and we've also undertaken a joint venture within the FY21 period as well. So a busy period for us. And we've since gone on following a successful fundraise in June, so post-year end, to complete 2 further accretive acquisitions in Knight CF and Knight R&D, so bringing further scale and strength to our M&A and our tax divisions. And we continue to build out our diversified professional services group that K3 Capital now is. Performance for FY21, from my point of view, has been nothing short of exceptional. We saw multiple upgrades to both revenue and profits as we came through the H2 period, remembering that our initial market consensus from this time last year was 36 million of revenue and 10 million of EBITDA. So to finish the year with revenues up over 200%, EBITDA up over 130%, in a year which saw all 3 divisions of the group delivering record performance in their own right, and contributing to what I would see as very much a team effort across the now newly formed and diversified group. I think that performance is even more satisfying when you consider that it's been achieved against the backdrop of a pandemic that we all know well, and clearly the disruption around office closures, lockdowns on a regional and national level have clearly all had an impact. But for those businesses to have performed in the way they have during that period, it's clearly, for me, a strong indicator of the quality and robustness of the businesses that we have within the group. The group, as ever, is cash generative. Circa 100% of EBITDA to cash conversion. We are a high margin business and continue to be so. And that cash generative nature sees us close the year on over 14 million of cash. That's up over 70% on the prior year. And again, achieved despite some of the smaller acquisitions that we've done being funded out of our own cash reserves. Operationally, we've started to replicate many of the working practices of the sort of heritage M&A division across the wider group. Things like KPIs and driving performance through KPIs and monitoring the business, both financially and through KPIs, has been a key area for us during the period. And again, from a shareholder perspective, as a group, we continue to deliver what we hope to be very attractive dividends to our shareholders. Now a progressive policy, which will deliver 9.1 pence per share this year, including the 6.1 pence final dividend that's been proposed. And that increases to 12.1 pence per share next year and 15.5 pence per share in FY23. So significant advancements moving forward in terms of our dividends. Andy, moving over onto page 4 if we can. So group structure, and really I guess to update you on the various brands that we now have and how they fit together within the 3 divisions that we now have. I think it's clear from the slide there that we are clearly creating a diversified group of what are SME-focused professional advisory businesses. We believe those businesses, therefore, to be far more balanced across the economic cycle, to be more robust in terms of the revenues and profits that they can generate, and made up, importantly, of businesses that have a great degree of commonality across their SME target audience. And that's important to us because that therefore means that those businesses can take advantage of the cross-selling opportunities and the distribution platforms that we have as K3 Capital in terms of our direct marketing and data and technology capabilities, and equally K3 Hub, which is our accountancy referral network. If we firstly then concentrate on the M&A division, which, as I would always refer to it, it's our heritage. It's what we've always done. It remains at the forefront of the group. It's performed exceptionally well in the 12-month period that we refer to here. We've seen fantastic levels of revenue, record ever levels of profit, and generated with a continuation of our strategy to build the volume brands of the business. When we refer to volume brands, we talk about Knightsbridge Commercial and KBS Corporate. These are our brands that are dealing with many hundreds of transactions versus the lower volume, higher value that comes out of the corporate finance brand. And that strength in depth that comes from the volume brands of the business gives us far more visibility of future revenues, and really focusing on driving the amount of sellers, the amount of buyers, and ultimately the amount of transactions that we create. And what that has allowed over time is for us to see a significantly reduced, if not an entirely reduced, reliance on the larger, lumpier corporate finance transactions that used to form a composite part of our forward-facing forecast, but now don't. They simply provide us really with upside opportunity rather than any downside risk. So those are the core 3 sell-side brands that have been sort of the heritage of the business for many years. Over the period, we've complemented those sell-side brands with, firstly, Market Mapping, which was a JV, essentially offering buy-side services to PLCs, private equity houses, family offices, or large corporate serial acquirers. Anybody that's really looking for assistance in uncovering off-market opportunities, so businesses that are not currently being touted around and marketed, very much in the same way that we did when we acquired the businesses that we acquired last summer. We've also headhunted a small team to form a new K3 Debt Advisory business. Again, just 2 people initially, but our aim would be to grow that business as that business generates cross-referrals from the wider M&A and restructuring divisions. Post-year end then, following the fundraise that I mentioned earlier in June, we completed the acquisition of Knight Corporate Finance. Knight is a sector specialist boutique operating predominantly in the telecom, tech, software, cloud space. That acquisition adds around £1.5 million of revenue, operating on a very similar margin to our M&A business, so about a 50% margin, and brings another further 10 colleagues into the group. Alongside Knight CF, when we approached them to bring them into the group, there was a new transaction services division about to be launched. This was a team initially of 3, a young dynamic team that had been headhunted from Grant Thornton and were keen to come and work in perhaps a more entrepreneurial environment to build a transaction services business. So offering due diligence, buy-side and sell-side services in a due diligence capacity. Again, delighted with how that business is kicking off. It's a startup essentially, carrying the brand of Knight, but starting to pick up some good work wins and driving further layers of growth and revenue through the M&A division. So in all, a very pleasing period for the division and quite a significant expansion of our brands. We see a strong future ahead for the core business as was, plus additional layers of growth coming from the additions that we've made both in FY21 and so far in FY22. Okay, move on to restructuring. So The Quantimer acquisition that we did last summer, of which there are 10 months of performance contributed to the figures that we're going to talk about today. But the Quantimer acquisition really provided the foundation for that restructuring division. It created cyclical balance across K3 revenues and has since been complemented by two smaller bolt-ons, those being Aspect Plus, which was a business down in the southeast that we acquired, and then overseas a business called Alchemy in the Cayman Islands. Both of those now rebranded and trading as Quantimer. We've continued to build capacity in our people, in our fee earners, and our fee earner base has grown quite significantly despite the suppressed market conditions that we've seen over recent times. So very much feel that the Quantimer brand now is well placed to take advantage of the returning market, and we'll talk a little bit further later on around how we see that insolvency market returning back to sort of previous levels and potentially accelerating beyond that. We've continued to build out our overseas footprint, and we've latterly seen key hires and office openings in BVI, the British Virgin Islands, alongside the Cayman acquisition, also in Dubai, in Singapore, and latterly in Poland and Eastern Europe. And those alongside our existing offices in Cyprus and in Cayman. The move sees us create, I guess, a low-cost entry point into that global marketplace. That global marketplace gives us the opportunity really to pitch for more complex, more lucrative pieces of multi-jurisdictional work, not just restructuring and insolvency, but often tying in asset tracing, which goes in very well with the forensic offering that Quantimer has. And whilst obviously in both growing our fee earner base and growing our international presence, we bring cost into the business, and there is a delay in terms of when that comes through to profit. Certainly we're seeing some encouraging signs in terms of work wins across the international network, and some of the pipeline that's coming through certainly underlines that strategy as being the right way forward for the business. So very much building diversity within Quantimer itself, in that it isn't just about UK restructuring and insolvency, it's also about forensics, it's about corporate finance, and it's about the build out of our international presence to create numerous revenues coming through the Quantimer brand. Finally, on to the tax division. Obviously, Rand created the foundation of the tax division last summer. And again, there are 11 months of Rand performance within the figures that we're going to talk to you about today. As we expected it would, it's performed well in the 11 months under K3 ownership. It was and is a solid, well-run, growing business. It was when we acquired it. And it's seen a strong year of double-digit growth despite the challenges of the pandemic. One of the key features there is that our K3 technology platform, Globe, which is the software that allows us to market to SMEs at volume as we do in the M&A business, and the launch of that sort of volume data and marketing approach is really starting to accelerate new client wins into the R&D business. So we see a lot of potential there for future growth and upside in much the same way as we've driven in the M&A division. In terms of additions in the year, tax investigations business completed in month 9 of the year, so around 3 months of performance of Intax in the numbers that you see today. On an annualized basis, that adds around $1 million of revenue, around 300k of profit, and brings again another 10 colleagues into the business. And more recently, the commencement of K3 Tax Advisory. That is a new service line that we've launched following the headhunt of initially a team of 2 from a mid-tier accountancy firm. That team, due to demand from both their own referral network and also from referrals from the M&A and restructuring division, we're starting to build that team, currently 6 people within that offering. So again, a launch of a new service line, additional layers of growth over and above the initial Rand tax business. And again, alongside the Knight acquisitions post-year end, we also acquired Knight R&D. I think the simplest way to look at Knight R&D and Rand and how they operate and fit together is in exactly the same way as our M&A division. So we have different brands within the M&A space that operate at different levels in the market. Some are high volume, low value. Some are low value, high volume. And it's exactly the same with Rand and Knight. Rand we would see as a higher volume, lower value player in that market, and Knight we would see as a lower volume, higher value player in that market. So those businesses very much seem to be complementary rather than competitive, in much the same way as our M&A brands effectively work in exactly the same market. So, Andy, if I can just pass over to yourself to pick up on page 5 in terms of the group financial highlights, and then we'll come back to strategy before splitting off into the individual brands.
Thank you. Yes, if we start off with revenue, group revenue at £47.2 million for the financial year, significant uplift by 215%. I think it's worth going into detail on this. So here we've split out, we have the red lines, that's the historic M&A business, revenue going from 13.6 million to 15 million in FY20. It's risen again by 7% this year to £16 million. I think it's worth reflecting that our financial year started on the 1st of June 2020. Clearly this was in the middle of a national pandemic in terms of local and national lockdowns. So from a standing start to deliver 7% organic growth, we're very pleased with. In addition to that, in FY21, we've got the 2 new revenue streams. The blue line here, we've got tax. This is the recurring nature of R&D tax advice, typically clients being contracted on 5 years, therefore a great visibility of earnings over a period of time. This has delivered £5.2 million of revenue in the 11-month period of ownership. In addition to that, we've got the purple bar here that is consumer. This is the counter-cyclical revenue that we've added to the group. This comes from many, many thousands of cases, not reliant on any one particular client to make up that revenue stream. And that's delivered £25.9 million worth of revenue for the year, and that's in a 10-month period of ownership. So combined, £47.2 million, a 215% increase. That then flows down into EBITDA as well. So historically, we've got the £5 million, which was the standalone M&A business, growing to £6.8 million in FY20. That's grown again to £8.3 million in FY21, delivering a 52% margin. So again, we show that this is a robust business that's driven by volume, generating significant profit margins that have increased year on year. In addition to that, we've then got the high margin from the tax division. From the £5.2 million worth of revenue generated, we've got £3.1 million of additional profit to add for the 11-month period. And again, we've got consumer on top of that that's delivered £6 million of EBITDA for the 10-month period. So a blend of margins there, north of 50% for the M&A division, circa 60% for the tax division, and circa 23% for the insolvency division. Overall, that gives us an adjusted EBITDA margin of 33%, which we think is well-rounded and well-blended with a diverse professional services group that we have today. I think at this point it's worth noticing that there is a slight change in accounting policy that has made an impact on FY21, and part of the reason for the slight delay in our results. For those who've known us for a while will understand that we have had historically highly prudent accounting policies in M&A. And by that, what I mean is our retainer fee income is deferred over a period of time, and our transaction fee income there's no accounting for work in progress, so until a transaction takes place, it won't hit our P&L. When we looked to acquire Consumer, we were very pleased that they had prudent accounting policies, and when we came out in February, we announced that our work in progress was circa 10% of annual revenue for UK insolvency. That, when compared to some of our listed competitors, sits at around 40 to 50%, is clearly highly prudent. Unfortunately, our auditors challenged us on that as being too prudent, and we've had to review our accounting policy and adjust accordingly. I think it's fair to keep in context that we've adjusted our work in progress policy. We're now around 20% of annual turnover sat in our WIP, so still highly prudent. But what that means is that we've added £1 million to revenue, and that has flown straight down into EBITDA, therefore £1 million of EBITDA. I think, again, to keep this into context, when we came out in December, we had market expectations of £10 million EBITDA. Clearly, over the year, we've issued multiple upgrades to turnover and to profits. And when we last came out, or when we last made an announcement in June, we said we would be no less than £14.2 million EBITDA. That was in the knowledge that we had a nice trading update, an uptick subject to audit. The reality is that we've delivered £14.7 million EBITDA, so a nice uptick on the 14.25 that was initially stated. But then we have the addition of this one-off accounting policy that puts an additional £1 million onto that and gives 15.7 million EBITDA. The new policy effectively has just raised the bar of the work in progress, so we're not expecting any further changes year on year. This is a one-off adjustment that we like to be transparent with. In terms of cash, we finished the year on £14.3 million, a significant increase on previous years. Clearly, we've got earn-out payments on top of this. John's touched on dividend policy, corporation tax. We believe that we've got sufficient cash reserves to meet all of our demands. We remain debt-free as a business, and the smaller acquisitions that may well be in the pipeline should be covered by this £14.3 million. I think it's worth also touching adjusted earnings per share. Whilst clearly during the course of the financial year we've issued a number of new shares that have been arguably dilutive, when we presented these opportunities, these acquisitions, we talked about earnings enhancing, being accretive acquisitions. So to be delivering a 50% increase in adjusted earnings per share to 18.56p, we think justifies our decisions to make these investments. As John touched on, dividends per share is 9.1p for the financial year, with the final dividend being 6.1p payable at the end of this month, subject to AGM. As mentioned when we came to the market back in November last year, we are fixing our dividend policy now, so 9.1p for FY21, rising to 12.1p in FY22 and 15.5p in FY23. And there are two reasons for this. One is to give investors certainty of income. We do have a legacy of income funds on our shareholder base, and we want to stick with that and give everyone the certainty that there will be distributions. But in addition to that, clearly with acquisitions, clearly with growth, both organic and inorganic, we expect revenues and profit to continue to grow. And by fixing our dividend policy, we then know we can generate surplus cash, which will cover earn-out payments and allow us to make further acquisitions going forward. I can pass back to John on growth strategy.
Yeah, thanks, Andy. So, again, for those of you that have seen us before, this is what we term our strategic wheel, and it's really there as a diagram to try and articulate to you the potential growth areas of the business. But to put some context around that, I think first of all we've hopefully proven, or indeed hopefully started to prove over the last 18 months or so, that our skills, our abilities as M&A advisors, because that's ultimately where we came from, the significant experience of our board and our senior team, all of that can be harnessed effectively to both identify, acquire, and integrate some quite highly accretive bolt-on acquisitions, and ultimately grow and develop our own group. So hopefully we've started to show, and those things are being proven through the numbers that we're delivering. We discussed in February at our interims that our short-term goal as a board, as a team, is to be a 25 million EBITDA business. We have a medium-term goal to be a 50 million plus EBITDA business. We want to build a £1 billion company here, and we see that as very realistic, and we see that as coming through a blend of both organic and inorganic growth. So I guess two layers of strategy, I suppose, to talk about. The first layer is undoubtedly, and it's the real layer because it's here and it's in front of us now, is the continued build out of the existing 3 service lines that we have. So whether it be M&A, tax or restructuring, we certainly see a long runway ahead of us in terms of developing out those 3 divisions. And just to look at how that's going to happen, and perhaps some real world examples of how it is happening. I think, firstly, we look at organic growth and market share gains across the different businesses in which we operate. An example of how we're doing that is utilising the Globe software that we have within the M&A business into the tax business for us to accelerate the client acquisition strategy of that business. So driving organic growth through utilising the assets that we have within the group. Secondly, lateral hires. We can build this business through bringing quality staff, fee earners, people who can build chargeable time, whatever it might be, into the group. Great example of that in the last 12 months is how we've increased the fee earner base in Quantimer, and we'll come on to some statistics on that later. But very much building the capacity, building up the resource within the business to drive those revenues moving forward. I think thirdly, then we look at bolt-on acquisitions as a growth area. Complementary businesses, complementary geographies. An example being the Knight CF business, the Knight R&D business, or complementary geographies, Aspect Plus, Alchemy in the Cayman Islands. Building out the divisions through bolt-on acquisitions. And fourthly, I guess either the headhunting and or the launching of complementary teams or service lines, the likes of K3 Tax Advisory, lifting a team from a mid-tier accountancy firm and then launching a service that is very complementary to what else we do in the group. Knight Transaction Services are another great example of that. So, 4 different ways there in which we feel that we can build out the existing divisions that we have. It seems to us that there is undoubtedly an exciting opportunity to do that. We can build a business of significant scale purely within M&A, tax and restructuring. There is absolutely a demand for high quality, independent, conflict-free advice, and our ability to promote our brands, to promote our offerings, either directly to SMEs through our sales and marketing platform, via cross-selling across the SME audiences of the various businesses within the group, or indeed via the K3 Hub referral network that we have. We see a great opportunity there to continue, as we have done over the last 12 to 18 months, to grow out those 3 service lines in quite a significant way. So that's the first layer of strategy. The second one is slightly less tangible and relates to what we would term internally as our 4th leg, which is deemed there as other, and that's future opportunity for us. There isn't anything on the immediate horizon, but clearly, as we have done with the 3 divisions that we've brought together so far, there is an opportunity for us to put a 4th or indeed in time a 5th or a 6th division in there to further diversify the group, to potentially bring high quality recurring revenues and profits to the business. Undoubtedly, that would probably be SME facing. So as per all the other businesses in the group, our market is UK SME. It would probably be professional services, something complementary to the group, and something that, as I say, brings further diversification to those revenue and profits. Difficult to comment or be too specific at this stage until obviously we've identified a target, but we would hope that target would be able to take advantage of those distribution platforms that I talked about, so the cross-selling, the Globe technology and the data and marketing that we have, or indeed the referral network of K3 Hub. I think, again, fair to say throughout the period, we've considered a number of opportunities that might fit into that 4th leg. Quite strict criteria around them being accretive, strategically fitting with the group, culturally fitting with the group, and looking at the quality of the people and the management teams within the specific targets that we've looked at. You can see from the acquisitions that we've done to date that we have a blueprint, we have a way in which we approach a transaction, very much around bringing people on the journey with us rather than cashing in and exiting aged shareholders potentially. So this approach of looking for well-run, well-managed, growing businesses that have a strong brand in their own market, that has the right cultural fit, and they see the benefit of coming on the K3 journey, as we would term it. So that's the strategic wheel. I think worth mentioning at this point, we have just taken on an acquisitions director to assist in that area. So all the acquisition work to date has been done by the existing management team of the business, and we've just recruited somebody from a private equity-backed business, so a head of acquisitions at a PE-backed business, quite an aggressive growing business, to very much look at both identifying, transacting, and integrating some of the pipeline and future acquisitions that undoubtedly we'll be looking at as a group. Okay, so at group level, that's it for now. What we'll do is we'll break away into each of the divisions to talk to you a little bit more about those sort of divisional highlights, cover off the split of the divisional performance again, and then look at some of the KPIs and the stats that sit behind that. So firstly, the M&A division. Again, as we've touched on, record profit performance in the period. Off a revenue of 16 million, we generated 8.3 million of EBITDA, which is a record level ever for the division. That has simply been achieved by mandating more sellers, finding more buyers, completing more transactions than we've ever done before, and also continuing our strategy of what we term bigger and better. So trying to move all of our brands up market all the time in terms of the average value and therefore average fee of the transactions which we handle. So two key drivers in the M&A division, one being volume and one being value. I think, again, these results are, ever more pleasing when you consider the backdrop of the pandemic. You consider the effects on UK SME, certainly in the earlier quarters of the year when offices were closed with the multiple lockdowns that were experienced, and many businesses shutting up shop and not wanting to look at M&A as a particular focus at that time. And I think our business has certainly exited the pandemic a lot stronger than it entered. We've seen operational efficiencies and cost reductions that we've been able to bring into the group because of this sort of new world way of working, the ability to interact with our clients, with buyers on screen to screen basis rather than traveling across the UK and indeed further afield at times. I think the quality of those earnings within the M&A division has again pleased me greatly. The volume brands that I touched on before, delivering a significant portion of that revenue and profit. So approaching 90% of that has come from the brands of Knightsbridge and KBS Corporate. Corporate finance, however, we remain very excited by that. But we're delighted to say that really now just provides us with upside opportunity rather than any downside risks to our forward-facing numbers. Because any of the larger fees that can come from that area are now not built into the forward-facing forecasts. As I touched on, I think earlier, the year just gone was one where we saw momentum build across the quarters. So Q1 was very much about getting the wheels turning again following the initial lockdown and the reopening of the office. We gained pace throughout each quarter. And if I was to put it into context, I think quarter one was well down on previous years. Quarter two was down a little bit. Quarter three was up a little bit, and quarter four really performed in certain KPIs at levels we'd never seen before. So very much a building momentum across the brands of the business, the KPIs of the business, and clearly we've gone into this year at that pace, at that high pace rather than the standing start that we had last year, which again gives us a lot of confidence for the year ahead. When we look forward to the coming year, our KPI performance looks strong. We've got the added benefit, as I mentioned, of Knight Corporate Finance, Knight Transaction Services, and the smaller additions of Debt Advisory and Market Mapping. So very much building out the strength in depth of the M&A brand, but with the three core businesses there, Knightsbridge, KBS Corporate Finance, really being at the centre of everything that we do in M&A. Over the page, in terms of the specific financials on the M&A division, you can see there the revenue progression over the last 3 years, 13.6 to 15 to 16 in the year just gone. So a 7% increase in revenue from 15 to 16 million. We certainly see double-digit revenue growth as an achievable statistic going forward. I think 7% in the year just gone, given the backdrop of the pandemic, is certainly very, very pleasing. And I think we would have snapped your hand off at that number at the start of the year. And equally, profit progression from 5 to 6.8 to 8.3 prior to allocation of any central costs. So, M&A revenues 16 million, and an M&A margin of 52% is certainly a very pleasing result against that backdrop. Some of the KPIs that we look at quite closely in the business over the page. And this is really just to give you a flavour. Again, I think the context of this is that quarter by quarter improvement. So if we'd have looked at these KPIs in Q1, they would have been significantly behind prior year. In Q2, they were behind. In Q3, we started to catch up. And the pace of growth saw us in Q4 actually getting to a point where all of our KPIs on a year-by-year comparison, we ended up on prior year, which again is quite a phenomenal performance given the context of the year. So new sales appointments, those are opportunities for us to go out and pitch our services to potential new clients. We're up by 12% in the period. We won 6% more mandates, so 6% more clients than the year before coming through our door. Because of that, our retainer fee income rose by 7% from a bank's perspective, 2% from a recognised perspective, because we recognise that revenue over the period of the contract. On the operational side of the business, again, very pleasing in terms of client satisfaction and how we are delivering on our promises to our clients. We achieved 25% more buyers, so registering now 25% more buyers than we were last year, and that continues to tick up period on period. Buyer meetings, therefore, were also up, so arranging 15% more interactions between our client, the seller, and a face-to-face meeting with a buyer. Offers up by 22%, so getting more offers for our clients' businesses, often multiple offers for our clients' businesses, and that ultimately results in building out of the transaction pipelines and ultimately growth in the transaction fee income line, which was up a very pleasing 11% in what, again, had started as a very difficult period. So overall, M&A revenues up by 7% in the period, as I touched on before, to that 16 million number. Okay, that concludes M&A. We move on to the restructuring division. So as you know, last summer we acquired what we very much believe to be a well-managed, high-growth restructuring business under the brand of Quantuma, a very highly regarded brand within its marketplace. And despite some real challenges in that market, a significant reduction in the insolvency market, really brought about by the government stimulus and the support packages, temporary changes to legislation on the back of COVID-19, we're delighted to be reporting a further year of double-digit growth, seeing the business deliver just under 26 million of revenue and 6 million of EBITDA in the 10-month period under which it was under K3 ownership. Again, keeping in mind the comments that Andy made before about the WIP adjustment, that was essentially 24.9 million of performance and 5 million of EBITDA that has been topped up by that change to accounting policy. So that market, that insolvency, corporate insolvency market, was down about 30 to 40%. Quantuma has clearly performed very well in terms of its own appointment levels within that period, and has therefore actually grown its market share quite significantly. We'll come on to some market share statistics shortly. How have they done that? Really, I guess a combination of areas. I think, firstly, continued investment into people, so lateral hires, recruitment of additional fee earners and additional IPs into the business. And that for us has really created a head of steam in terms of our capacity. And as we look ahead to the anticipated uptick of that sector to more normal, normal levels of insolvencies, more normal market conditions, and potentially even accelerating through that to accelerated levels of activity, we've built up a head of steam in our capacity to be able to take advantage of that. I think secondly, the development of the forensic team and the corporate finance teams, which again, the corporate finance team working particularly well with the M&A division in terms of handling some of the transactions and some of the clients that we have that are perhaps more appropriate to their experiences or skill sets or sector expertise. Thirdly, the bolt-on acquisitions have obviously added to that base and that strength in depth. Aspect Plus in the UK, Alchemy overseas, all completed from cash reserves, bringing additional fee earners and additional revenue in the period. And finally, we continue to build out of our representation and our strategy in key offshore financial centres. And we've chosen to do that strategically through key hires and office openings rather than through acquisition. And that has been around headhunting quality individuals in the territories in which we want to operate, and then opening an office and putting some resource around them. I think just to come back to some of the statistics in terms of the marketplace, we've seen a market that has been significantly subdued over a sustained period because of those government support measures. What we're seeing now in the statistics and anecdotally from our managing directors around the UK is that there is undoubtedly an uplift in that activity in the market. And in the last 3 to 4 months, we've seen appointment numbers in the UK jump quite significantly, now back to what we would see as more normalised pre-pandemic levels. So September, for example, there was over 1,400 insolvency appointments in September as a month, and that compares with, say, just over 700 in January at the start of the year. So, there's certainly the statistics and the anecdotal evidence that market is certainly returning to pre-COVID levels and may in time certainly potentially accelerate beyond that. But Quantimer as a brand, it's a volume independent player in that market. I think ranked currently second behind only Begbies in terms of the market share, the amount of clients that it is dealing with. Market share currently around 5%, as indicated in the graphs there. Also, delighted, I think worth mentioning the recent high-profile appointments of the Derby County Football Club job, which again, alongside a sizable fee, which is always very pleasing, brings a lot of brand awareness. Our directors being interviewed on Sky Sports in the national press, etc. Great for profile, great for brand awareness, and we're really pleased to be winning that sort of job. But equally remembering that Quantimer has been built upon a strong foundation of volume rather than a smaller number of high-value cases. But indeed, there lies the opportunity, exactly the same as we've done within the M&A business. If over time we can move up market in terms of the average fee value of the clients that we're handling, then we get two growth drivers, volume and value. So cases like that clearly contribute very well to that sort of theory. Just back a page, Andy, if you could, in terms of the divisional financials. No comparative periods here in terms of year end, but we've put the March 19 and the March 20 numbers there in just to show the progression. But in the 10 months of ownership, 25.9 million, including the adjustment to work in progress, 6 million of EBITDA, again, including that adjustment. So presentationally here, a 23% margin. Actually, if you strip out the WIP adjustment, a 21% margin. But again, for 10 months of ownership, very pleasing with the results that Quantimer has delivered. And we look forward to that market very much returning to more normalised levels of activity as we move forward. Okay, I think we've covered that, Andy, in terms of the KPIs. And again, if we move on to tax, highlights on page 16 there. Again, a record trading performance within the tax business. It sounds like a broken record here, but all three divisions, delivering record performance is really pleasing to see. Rand has accelerated its pre-acquisition growth rates. And when we build on top of that, the acquisition of Intax, we see revenues of 5.2 million, delivering an EBITDA of 3.1 million. And that relates to 11 months of Rand ownership and 3 months of Intax ownership. In Q3 of the year, we saw the launch of the K3 Globe technology. So the technology and the data and the volume direct marketing approach that has been really the backbone of the growth of the M&A business. In Q3, we rolled that out into the tax business and started to trial and test and develop that offering and really drive the client acquisition strategy of the tax division. I'm pleased to say that is performing well, and we've already seen new client wins increase by 50%. Again, we'll come on to some statistics shortly. One acquisition in the period, which was Intax, which I mentioned earlier in month 9. That business brought an additional 10 colleagues into the group. Annualized or on an annualized basis, that adds around 1 million of revenue and around 300k of EBITDA. And that's now based within our Quantimer London office and doing some good work with the Quantimer forensics team as well, which is nice to see. Right at the end of FY21, we launched, as I mentioned, K3 Tax Advisory. This has a lot of synergy with our M&A division and the colleagues within the M&A work and also within the restructuring side. Initially formed by headhunting a small team of 2 from a mid-tier accounting firm. We've continued to build that resource as we've seen demand and referrals grow. We now have 7 within that team as we look forward to the year ahead. So momentum is building, and again, it's just further diversification of the revenues within that division. And lastly, as we mentioned with the M&A side, post-year end, we've acquired Knight R&D alongside the other Knight brands. That brings additional scale, it brings strength in depth, deep sector knowledge to our R&D offering, adds around 20 colleagues across the group, 10 in the north, 10 in the south, and again, brings around 3 million of revenue and around 2 million of EBITDA to the group as we move forward through FY22 and beyond. Financials over the page, again, just confirming divisional revenues of 5.2, EBITDA pre-allocation of central costs 3.1, operating there at a very impressive 60% margin. And the KPIs, again, just a couple of things here in terms of showing how the introduction of Globe into the business is starting to drive some of the client acquisition growth. But you can see there, historically in 2019, the business was winning 10 new clients a month. In 2020, that grew to 15. And last year, despite the fact that we only launched that in month 8, we saw 23 new clients on average per month being added to the business. And we would certainly hope to see that trend continue as we move into 22 and beyond. And ultimately, that is a very simple business. You win more clients, you submit more claims to HMRC, and ultimately that generates more revenue and more profit. And you can see there the increasing revenues the increasing statistics in the claims submitted to HMRC as well. In terms of the budget last week, there was, as we expected, mention of R&D in a number of areas. I mean, I think the fact that it was talked about quite significantly is certainly a positive. Rishi Sunak underlined the government's view of continued investment into the R&D space and very much sort of reaffirmed the targets in terms of that increased investment over the coming years. So that was very much a positive for us. Slight changes to the scheme in terms of incorporating from April 23 cloud and data costs within the claimable expenses, which again, obviously we welcome and a lot of our clients will welcome. Equally, it opens up some potential new areas of the market for us. A couple of things to note. I think he talked about, again, from 23, talked about qualifying spend being domestic spend, not international spend. Again, for the vast proportion of our clients, that doesn't really apply because at the SME level that we're at, most of them, that expenditure was in the UK anyway. So no significant negative impact there at all. And the other thing he talked about was increasing regulation and compliance within the sector, which again, we welcome. Both our brands, Rand and Knight, are well-established, high-quality operations. They have a high-quality control element to them. They have strong reputations with HMRC and a very high rate of success with the claims they submit to HMRC. And we audited that at acquisition, and both were 100%. So, any increasing regulation for us as quality brands, we see as a positive. And will perhaps help to keep, some of the perhaps lower quality new entrants in that market at bay. But yeah, very very pleasing performance from the tax division as a whole. I'll just pass you back to Andy now, if I may, just to give you a bit more detail around the financial statements, and then we'll come back to current trading.
Thank you. I think we've covered most of the headlines in here in terms of turnover increasing to £47.2 million and the adjusted EBITDA, and obviously also discussed the WIP adjustments. I think in terms of adjusted EBITDA, clearly we've got the usual adjustments in here for share-based payments, for depreciation, for amortisation. In addition to that, this year there are two items. One is straightforward enough, the transaction costs. Clearly, as part of the fundraiser, a number of professional fees, including due diligence and such like, that we're adding back as exceptional. A large area here that's worth just pausing on is deemed remuneration, the £3.9 million that we're adding back. So to be clear here, back in January, we asked our auditors to do a red flag review of our accounting policy ahead of the interims being published. So clearly we had a number of acquisitions that had been made, a number of changes to our accounting policy that we wanted to make sure were broadly correct and everyone was happy with ahead of us publishing these results. We were therefore quite disappointed at a late stage in the audit to not only be challenged on the consumer WIP that had been previously not necessarily signed off, but certainly no red flags raised. We were also challenged on the earn-out of consumer. So this purely relates to consumer, which, to refresh everyone's memory, we made this acquisition with 60% cash paid up front, 20% in shares with lock-in periods, and finally a 20% in earn-outs paid over 3 financial years. That itself is paid in part cash and part shares, again with those shares having lock-in periods. The whole point of the earn-out and the lock-in periods is to tie the vendors into the growth of the business, to keep them part of the PLC and to protect shareholders. In addition to that, what we've put in for the earn-out of consumer was forfeiture rights. So there were 32 sellers of the business. If any one of them were to leave employment within the 3-year period, they as individuals potentially forfeit their rights to the earn-out payment. PLC still pays the same amount to the remaining sellers, but that individual may potentially lose their right to the earn-out. As a consequence, there is an IFRIC's ruling or precedent that's been previously set that says that anything that is linked at all to employment needs to be classed as remuneration. Now, clearly, as far as the share purchase agreement is concerned, the transaction is concerned, as far as tax is concerned, all of this is an earn-out as a payment for shares. It's for a defined 3-year period that's linked to the performance of the subsidiary, and is clearly not remuneration, albeit we now have to account for this as we have done. The consequences of that are clearly it hits the P&L, that affects bottom line earnings per share, it affects our distributable reserves. But for us, this is more a frustration than anything else. It doesn't impact our ability to pay dividends. We'll adjust this out accordingly because it is a transaction cost and not an operational cost. I think importantly, we're not proposing on changing our acquisition strategy to suit our auditors. We've put these clauses in here for a reason, that is to protect the shareholders and protect the business. We want to make sure that anyone that is coming into the K3 group is on board for a long period of time, who's bought into the growth story that we're presenting to you and is part of the journey. Therefore, we believe that there will be more acquisitions that are like this. Knights being one, so again, there's the same forfeiture clauses that are in here. So deemed remuneration will be a part of the P&L for the next 3 years and beyond, subject to how many more acquisitions we make. I think the only thing, just to reiterate on here, the headline earnings per share, clearly by adjusting these back, we still have that 50% increase in earnings per share despite the dilution that we've had over the period. Moving on to the balance sheet, quite significant changes, as I'm sure you'd expect. Mainly at the top being intangible assets, as the goodwill for the acquisitions that we've made. Important to note that all these acquisitions that we've made have come with normal levels of working capital. We believe that we're on top of working capital management to make sure that we are focused very much on cash collections, on recovery rates and such like, to make sure our balance sheet is as optimal as possible. We do have a debt facility in place with HSBC at £15 million, albeit that is currently unutilised. Whilst we do have contingent consideration on here, we do remain debt-free as a business. And finally, in terms of the cash flow statements, large items in here, as I'm sure you'd expect, the inflow from the proceeds of issue of shares, which was for the fundraise that we did during the summer, and again, the acquisitions of subsidiaries being the main outflows. The one thing to note here, cash generated from operation, we are seeing over 100% EBITDA to operating cash conversion rate. Historically, as an M&A business, we've been highly cash generative. We believe that the companies that we bought and brought into the fold, with a combination of these prudent revenue recognition policies and also our focus on cash generation, debtors, working capital management, we believe that we'll continue to be highly cash generative going into the future. Just hand back to John on current trading, future outlook.
Yeah, I guess so. Summary looking backwards before we look forward. You know, we're delighted with what has been, in our view, an outstanding performance in the FY21 period. It has been a pivotal year for K3. It's seen us significantly over-deliver on the initial market expectations, whilst at the same time, you know, simultaneously creating this multidisciplinary group that you see on that structure today. Yeah, I'm delighted to be reporting that the momentum that we built throughout the quarters of last year, once we returned from the initial lockdowns and the impacts of the pandemic, has very much continued into FY22. You know, and revenues for the first 4 months are firmly in line with current consensus revenues in the market. You know, divisionally, the M&A division is experiencing, as I mentioned before, sort of, you know, almost record levels of KPI activity in certain areas of the business. You know, that is driving strong transaction fee pipelines. We would look forward again to this year completing more transactions than we completed last year. That gives us great confidence for the rest of FY22 and indeed beyond. And if we build on top of that, the year-end acquisition of Knight CF and the Knight Transaction Services business coming through, these are all additional and further layers of potential growth over and above those core brands. The restructuring division, to touch on that, you know, as we touched on, has invested and built capacity in its people and its fee earners, And as that market starts to return to more normalized levels and potentially accelerated levels of activity, we certainly feel that we are well placed to capitalize through H2 and indeed beyond into next year and beyond that. The build out of that international offering, the build out of the forensics team, the expansion of that and the corporate finance team, it all brings strength in depth to that division moving forward. From a tax perspective, as you see, we've continued to strengthen, to scale, to diversify our tax division. Initially starting with one brand that now comprises of Rand, of Knight R&D, of Intax, and of K3 Tax Advisory. So 4 contributors there to performance. And again, we're certainly confident in delivering consensus numbers in that area of the business. So, myself and the board confident in the delivery of the expected market consensus performance for FY22. We look forward to updating the market further in terms of both performance and potential acquisitions following our H1 period end at the end of November. As Andy mentioned, our cash balances are strong. We have the debt facility in place. It keeps us nimble when considering these accretive and complementary acquisitions. And we look forward very much to another exciting year ahead in terms of what K3 Capital can achieve, both from an organic and an inorganic perspective. And that's it in terms of formal presentation, folks. So thank you very much for that.
That's great, John. Andy, thank you so much for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Andy and John take a few moments to review the investor questions that have been received so far today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be available via your Investor Meet company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, you'll be redirected for the opportunity to provide feedback so the company can better understand your views and expectations. Not a long time, guys, for you to read the questions that have come through, but perhaps if I could, obviously I know we had a pre-submitted question, which I know you've addressed in the presentation itself, but perhaps I could hand back to you to read out the questions that have been received, perhaps who they're from, and give a response where it's appropriate to do so. Yeah.
Andy, are you comfortable that first pre-submitted question has been covered off, or is there anything you want to pick up on that?
I think just to clarify, someone submitted a pre-submitted question that says there's a bit of confusion in terms of the earnouts and the accounting treatments of it. Just to clarify, the £23 million maximum paid is exactly that. AIM rules dictate we need to put caps on earnouts, therefore the £23 million is the maximum we would pay out. And clearly there needs to be a significant uplift in performance of all companies to get there. The £14 million that you refer to is the fair value, so that's the amount that we expect to pay out over the next 3 to 4 financial years. That's the difference between the 14 million and the 23. And finally, to piece the jigsaw together, the £4.2 million on the balance sheet, this is the deemed remuneration point that we talk about. £4.2 million is contingent consideration. The bridge between that and the £14 million fair value is now deemed remuneration, therefore not on the balance sheet. Hopefully that clarifies matters.
Okay, next question from Michael D. You have been very active with regards to M&A. We certainly have. How active do you feel you will be moving forward, and are there any verticals you feel it would be good to be in? I think hopefully we sort of covered that off within that strategic wheel discussion. We see organic and inorganic growth as being key to the business moving forward, and we see that acquisitive growth being potentially within the 3 divisions that we have, and also potentially within that 4th leg and that area. There are a number of verticals that we see as being potentially appropriate. I think we haven't certainly got time to discuss them all now. But the principle remains, we are looking for, whether it be in our existing divisions or outside of that, high quality, growing, accretive businesses, strong management teams, strong brands, and businesses that really can benefit from being part of that K3 journey. Brendan R. Andy, I'll let you take this one. Good to see the progressive dividend policy. Is this based on a defined relationship between expected earnings per share and the dividend?
Yes, thanks for that, Brendan. So I think historically we've had a dividend policy that is variable, that's linked to a percentage of profits after tax. And clearly, I think, as I've already touched on, that as we grow as a business, we wanted to make sure we were conserving cash whilst making sure that we were paying a progressive dividend policy to our shareholders. We've looked at market expectations of our profits, and we've looked at the cash generation that we believe that will throw off in terms of all the subsidiaries, and that's after the likes of tax has been paid and all these earn-out payments. So in essence, there's no direct link between earnings per share. We've put forward this dividend policy effectively to make sure it is progressive. It gives our shareholders certainty that there will be distributions over time, and it's something we'll look to review for FY24 when we come out with numbers to continue that progressive growth line. Hopefully that helps.
A question from Anthony M. Are you disappointed with the market's reaction to the full year results? Yeah, I suppose the only answer to that can be yes, we probably are a little bit, but equally we don't get too hung up on it. Our view is very much a sort of build it and they will come mentality. We focus on the things that we can control. We focus on building a successful business, a successful group, delivering impressive numbers. Hopefully we've done that this week, and I'm sure at a certain point in time that will be recognised within the market. But yeah, short-term fluctuations and such we try not to get too concerned about, and are thinking more about the longer-term strategic direction of the business. Question from Damien C. Do you see a material change in operating costs during the pandemic? Or sorry, did you see a material change in operating costs during the pandemic, such as moving to virtual rather than face-to-face meetings? If so, are these cost changes unwinding now? Yeah, I mean, there has certainly been lessons learnt from the pandemic in terms of some of the operational efficiencies that that were forced upon us initially, but then we've been able to adopt and maintain moving forward. So a lot of our interactions with clients now, with buyers now, are able to be done on a screen-to-screen basis rather than a face-to-face basis. We have significantly reduced the amount of business mileage, the amount of trains, planes, automobiles, etc. The whole thing is reduced significantly. That does have some impact on costs, and that's been obviously a positive in the business. But what we've seen, and I won't say post-pandemic because clearly we're not post-pandemic yet, but we've been able to maintain a lot of that operational efficiency since we've come out of the sort of initial phase of the pandemic, and still a lot of those interactions are happening on a screen-to-screen basis rather than a face-to-face basis. Our new business appointments, for example, 90% of them are still done on a screen-to-screen basis, which I think is a lot more efficient for us, but equally for our clients. It helps with things like confidentiality. They are busy people running businesses and running funds and PE houses themselves. So being able to do these things without traveling on a screen-to-screen basis is often better for the client or the buyer or the seller or the PE house or the funder or whatever it might be, as much as it is for ourselves. Mark B, question: as insolvency market improves, would you expect an improvement in EBITDA margin in the restructuring division? I mean, I think as we've said, Mark, the numbers that you see on screen with 23% margin, actually, from my point of view, near a 21% margin in terms of the unadjusted position, if you like, outside of that whip adjustment. I think the consensus numbers in the market show about a 22% margin, so bang in between those two. And really, we would see that as being about right for the division at the moment. I think potentially in time, if we can, and as we scale that business and that division and potentially move up market in terms of some of the fees that we're handling, there is an opportunity to improve that margin. But we're comfortable at that sort of early 20s mark for the foreseeable future. Andy, I'll let you take this one. How do we manage the risks of relatively high fixed costs in the consumer expansion?
Yeah, I think it's important to know that we've got a lot of management KPIs within the group. So something like consumer that has clearly a lot of people, a lot of headcounts, a lot of overheads. We monitor every individual in terms of chargeable time, in terms of utilisation rates, and even recovery rates on the back of that. So everyone's individual performance is managed. Clearly, there is capacity within those individuals. No one's at 100% utilisation rate. We only look to recruit and take people on as and when we feel there's a need to. I think, as John has touched on, that we have taken on new recruits to build ahead of steam in terms of the market coming back. But I think it's fair to say, whilst there is a relatively high fixed cost, we think there's significant upside in terms of revenue that we can build within that capacity. So it doesn't cause any concerns.
Question from Douglas G. You gave us the market share of restructuring. Could you give us any idea of the market share and how fragmented the other industries are, please? Yeah, I think if we look at, we could probably answer those in a similar way. M&A and the tax side are both highly fragmented markets with small operators through to small, medium-sized accountancy firms, through to sector specialists, through to your big four, and all play in both the M&A and that tax market in exactly the same way as we do. There are no absolute statistics on M&A in terms of the number of businesses that sell each year across the various size points that we handle, but we would certainly estimate our market share to be no more than 1 or 2% at most. So clearly a lot of opportunity for market share growth in the M&A division. And equally on the tax division, if you look at the number of R&D claims that we make as a group versus the total number of claims that are made in the market, again, you're talking 1 to 2% market share. So, huge opportunities across all three divisions to grow market share and drive that organic growth story, Douglas. So thank you for that question. Have we got any more there, Andy, that we've missed out?
Andy, John, I might just jump in just to...
Sorry.
No problem at all. I'm just mindful of both your time and of course, if any other questions do come in that perhaps you want to address, obviously we'll make those available to you post the meeting. But firstly, thank you to everybody that's taken time to submit the questions this afternoon, early evening. Guys, I know investor feedback is particularly important. We'll shortly redirect investors to provide you with their thoughts and expectations. But John, perhaps before doing so, I could just ask you for a few closing comments just to wrap up with.
Time and for listening to what Andy and I have had to say today. We appreciate that, and we welcome the forum of IMC to be able to do that to this community at some volume. So thank you for listening. As I think we've talked about, it's been a very, very pleasing year in terms of the numbers, but more than that, it's been a pleasing year in terms of what we're putting together here and what we're building as a group. And we're hugely excited by the future and what we can achieve. We think we've got some fantastic ingredients, and to get those working together and delivering a prosperous future is very much the focus now. So hopefully we've covered off everything that people wanted to hear, and we look forward to updating again following H1 period. Yeah.
That's great. John, Andy, thank you once again for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of K3 Capital Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon or early evening to you all.